Before starting the video, click the subscribe button and turn on the notification bell. In this video, we will discuss about introduction to company and company's accounting. So stay tuned and watch the whole video. What is joint stock company? Joint stock company is a form of business which is unlike sole trader and partnership. In sole proprietorship, there is only one owner and he does not share the profit with anyone. In partnership, there are limited number of partners and they share the profit among them. But in joint stock company, there are shareholders and it is not specified by any law that how many number of shareholders should be there. So it is a company, it is a form of business which is owned by the shareholders and there is no specified limit of shareholders. What is share? Share means an ownership certificate that authorizes the person who owns that shares to a certain percentage of profit to the extent of percentage of shares owned by him in the company. If a person owns 10% of the shares, so that means he owns 10% of the profit. So let's move to the types of shares. Number 1, ordinary shares. These are the types of shares which authorizes the holder to have the normal dividend on shares held by them. Now what is dividend? We shall discuss it now. And these type of shareholders share the profit in the form of dividend and are party to the loss as well. Means if the company will suffer the loss, the ordinary shareholder will suffer the loss as well. Then on number 2, preference shares. These are the types of shares that authorizes its holder to enjoy a fixed percentage of dividend and they are given priority over the ordinary shareholders. So if the company earns any profit, so the preference shareholders will be given the profit earlier than the ordinary shareholders. Dividend. Dividend means the profit distributed to the shareholders on their shares. Means if a person owns 10% of the shares of the company, so 10% of the profit will be given to him and that profit, that income over shares will be called as dividend. So there are 2 types of dividend. Number 1, cash dividend and the other one, stock dividend. Now let us take a look on cash dividend and stock dividend. So cash dividend. This is the type of dividend given to the shareholders in the form of cash. All dividend, you have to note one thing, that all dividends are given out of retained earning. So the journal entry will be retained earning debit as it is an equity account. So when the cash will be taken out of it, it will be decreased. So whenever equity is decreased, it is debited. So retained earning debit and a liability over the company to pay the cash dividend will be created. So cash dividend payable is a liability account and therefore it shall be credited. Then bonus or stock dividend. Bonus or stock dividend means if the company wants to retain its cash and does not want to distribute that cash and want to use it for a specific purpose, so what will the company do? The company will distribute the shares instead of the cash. So that distribution of stock or shares will be known as a stock dividend because they are given on part of instead of that cash that should be given as a form of dividend. So let us take a look on this. This type of dividend given by the company in the form of shares. Amount of shares given on account of stock dividend is equal to the dividend earned by the shareholder. So the journal entry will be retained earning debit as the amount equal to the stock dividend shall be set aside by the company for a specific purpose. Then share capital credit. As we have discussed before, that shares are given and the shares when issued are credited by the share capital account. So whatever the form of issuance of share is there, share capital will be credited. So the thing which differentiates the joint stock company from the other form of businesses is its equity. So how many equities are there in joint stock company? There are 5 equities, namely share capital, share premium, share discount, retained earning, and reserves. So let us take a look at what these 5 equities says and what are that. Number 1, share capital. It is an account where all the investment made by the shareholder is recorded. Note that it is always recorded by the par value, which is rupees 10. So the journal entry will be cash or bank will be debited and shares capital will be credited. Shares premium. It is the account maintained to record the amount received by issuing shares and exceeding the par value. For example, if a company issues a share at rupees 15, so 10 rupees shall be credited by the share capital, as we have discussed before that share capital shall be credited by 10 rupees whatsoever the condition is and whatsoever the market value of the share is, and the 5 rupees exceeding 10 rupees shall be credited by share premium. So this is the account which is maintained to record the exceeding amount only. Then share discount. It is the account maintained to record the amount decreasing than the par value. If, for example, a company issues the shares at rupees 8, so the share capital shall be recorded by the same value of rupees 10, and share discount shall be recorded by the difference amount of rupees 2. So the entry shall be cash debit 8, share discount debit 2, and share capital shall be credited by 10 rupees. Retained earning. In English, the word retain means to keep something. So here the word retained earning means the same to some extent. This means that the earning which is retained by the company to spend on distribution the earning to the shareholders and to reserve some amount for the internal operations of the company. Reserves. Reserve means the amount set aside by the company for specific internal operations. So you will see the words in the entries like reserve for plant extension, that the company can save its amount for the plant extension, or the reserve for any purchase of asset, reserve for sinking funds, and reserve for contingencies. So company can set aside any amount for all these operations. So when the shares are to be issued, before discussing this, we have to keep in knowledge that whenever the company issues the shares, the next party becomes the shareholder, and his or her amount shall be credited to the shares capital account. So the shares are said to be issued when they are issued against cash. So what will be the entry? Cash will arrive to the company, so it will increase and it is an asset. So cash will be debited and share capital will be credited, because whatsoever the condition is, if the shares are issued against anything, that shall hit share capital account and share capital account shall be credited. The next condition is issued against purchase of any asset. So asset account will be debited because asset is arriving to the company and we're giving the shares against this asset. So share capital shall be credited. Then issued against settlement of any liability. So when the liability is being paid, although it is being paid by issuance of shares. So liability is reducing, it is being declining. So liability is debit and share capital will be credited. Now let us take a look on the entries of issuance of shares. Number 1. Issued 3000 shares at par. As we have discussed before, that par value is always 10. So cash or bank shall be debited by 30,000 and share capital shall be credited by 30,000. Then number 2, issued shares for rupees 15. So cash or bank, one thing you have to keep in notice that cash and bank shall always be debited by the market value. So cash or bank shall be debited by 3000 into 15, 45,000. Then share capital shall be credited by 3000 into 10, 30,000, and share premium shall be credited by the exceeding amount of 5 rupees. So 3000 into 5, 15,000. Then number 3, issued shares for rupees 8. So the market value is 8, therefore the cash or bank shall be debited by the market value. So 3000 into 8, 24,000. Then share discount. Share discount will be debited by the difference amount in the market value and the par value. So share discount 3000 into 2, 6000, and share capital shall always be credited by the par value, and the par value is 10 always. So 3000 into 10, 30,000. Now let us take a look to the case that issued shares against assets. Issued sufficient number of shares of rupees 12 for purchase of asset of rupees 36,000. So asset shall be debited by 36,000 by its cost, and share capital shall be credited by 3000 into 10, 30,000. So how we got 3000 into 10, 30,000, we shall see in the note. Then share premium, as the shares are being issued at rupees 12, so 2 rupees will go to the premium, and 3000 into 2, 6000. Now let us take a look on the note. As 36,000 and 12 are given, but we do not have a number of shares, so we cannot multiply it by 10 and multiply by 2. So what we have to do is to divide this amount by the market value. Then we will get 3000, and we'll be able to multiply 10 and get the amount of share capital, and the same 3000 will be multiplied by 2 and we'll get the amount of share premium. So that's all. Then issued 2000 shares against a settlement of liability of 24,000. So liability of 24,000 shall be debited because it is being paid and liability is being reduced. Then share capital by 2000 into 10, 20,000. Now we do not know that either they're sold at premium or discount, but we know that the share is of rupees 10 always, and the liability is 24,000. So 24,000 liability is being settled by 20,000 shares. So 4,000 is in the benefit of the company. Therefore, we will record it as a premium for the company. So that's all for today, but this is just part 1 of the lecture. Part 2 shall be uploaded tomorrow, and stay tuned for that. Till then, good luck.